Silver just moved, but not the way most people expected. A gap, a shift, a number on the screen that quietly changed the story overnight. Because right now, gold is sitting at a level it has tested before. And every single time it tested this level, something happened next. Silver is doing something it has only done a handful of times in years. And the ratio between gold and silver, the number very few retail investors even track, just broke. If you know what that ratio means, you already know why serious money is watching this week differently than any other week in 2026. If you don't, by the end of this video, you will. Because what happens in the next 24 to 48 hours in these markets could decide who protects their wealth and who doesn't. Stay with us. This is The Alert. Welcome back to Currency Arc Insight, the channel built for people who take their money seriously, not casually. If this is your first time here, hit subscribe now, because what you're about to hear is exactly the kind of economic signal most people miss until it's too late. Before we go further, drop a comment and let us know which city or country you're watching from tonight. We read everyone. On the morning of July 27th, 2026, something quiet but important happened in the precious metals market. While most people were still asleep, silver opened with a sharp gap upward, rising more than 2.5% in a matter of hours. To the average person scrolling through headlines, this might look like just another number on a screen. But to those who study markets closely, this single move tells a much bigger story about where the economy may be heading next. Silver is now trading above $57 per ounce in US currency terms. This is not a random spike. It follows a specific pattern that serious analysts have been watching for weeks. For the first time in this recent downward cycle, silver has formed what technical analysts call a bullish divergence. In simple terms, this means that even though price made a new low recently, the underlying momentum did not confirm that low. It quietly signaled strength while the price still looked weak. This matters because bottoms are not usually announced with fireworks. They form quietly, often while public sentiment is still negative. The first lower low followed by a higher low is considered the earliest technical requirement for a genuine market bottom. It does not guarantee that the bottom is in, but it is the first domino that needs to fall before any larger recovery can be taken seriously. At the same time, something important is happening beneath the surface. Silver is now trading inside what long-term investors call the best buy zone. This is a wide price range, stretching from around $58 down toward the high 30s, based on long-term logarithmic support levels. Historically, this zone has represented the area where major buying interest tends to appear. It does not mean the price cannot fall further within this range. It simply means that within this range, patient buyers have historically stepped in. For someone new to precious metals investing, this concept is important to understand. Markets rarely move in straight lines. They test emotions before they test technical levels. A price gap like the one seen this morning tends to attract attention, but experienced market watchers know that gaps often get revisited before a trend truly continues. This is not weakness. It is simply how markets behave when large amounts of capital are repositioning. Meanwhile, gold is telling its own version of the same story. Gold is currently trading around $4,090 per ounce, showing a smaller move than silver, up less than 1% for the day. While this may look less dramatic, gold's structure is arguably more important for the broader economic picture. Gold represents the anchor of the entire precious metals complex. When gold moves cautiously while silver moves aggressively, it often reflects a market that is still deciding its next major direction. Unlike silver, gold has not yet entered its own best buy zone. According to long-term support analysis, that zone sits much lower, somewhere between $3,670 and $2,780. This tells a more cautious story. While silver may be closer to a potential turning point, gold suggests the broader market may still have more room to move before any deeper opportunity appears. This is exactly why serious investors do not look at gold or silver in isolation. They study both together because the relationship between them often reveals more than either metal alone. When one metal moves faster than the other, it usually signals a shift in market psychology, not just price. And right now, that relationship is beginning to shift in a way that has not been seen in quite some time. For business owners, entrepreneurs, and anyone serious about protecting long-term wealth, this moment deserves attention. Precious metals have historically served as a hedge against currency devaluation, inflation, and broader economic uncertainty. When technical structures like these begin lining up quietly in the background, it often means the market is preparing for its next major decision point long before mainstream headlines catch up. The question now is simple. Has silver truly found its bottom? Or is this only the beginning of a much bigger move that will test both metals in ways most investors are not yet prepared for? To answer that, the next step is understanding exactly where the real decision lines are drawn. Because in this market, two specific price levels for both silver and gold now stand between clarity and chaos. Every market eventually reaches a point where it must choose a direction. silver has arrived at exactly this point. After the recent gaps higher and the early signs of a bullish divergence, the metal now stands at a crossroads that will likely determine its next major move over the coming weeks. On the upper side, silver faces a critical resistance zone near $61 per ounce. If silver can push through this level with strength, it would confirm something technically important. It would create what analysts call a higher high, following the recent higher low. This combination is one of the clearest signals that a genuine shift in trend may be underway. A break above this level would likely open the door to a more sustained rally, giving confidence to those who believe the recent low was the true bottom. But markets rarely move in one direction without resistance. If silver fails to hold above the $57 mark instead, the story changes completely. A breakdown below this level would suggest that the recent bounce was temporary and that sellers still have control. In that scenario, a new low below the previous support near $54 becomes far more likely. This is the other path, the one that would delay any recovery and test the patience of investors who believed the bottom was already forming. This is what makes the current moment so important. Unlike many periods in the market where the picture is unclear, silver right now offers a very simple structure to watch. Break higher and the recovery story gains strength, break lower and the market signals more downside is coming. There is very little middle ground left. The next move will likely answer a question that has been building for weeks. Gold is walking a similar tightrope, though at a different pace. Currently trading near $4,090, gold must clear a key resistance level around $4,165 to confirm a similar bullish structure. A break above this level would create a higher high following its own recent higher low, matching the same pattern forming in silver. If this happens, analysts would expect gold to test higher levels, potentially moving toward the $4,500 to $4,600 range in the following weeks. However, gold also carries its own downside risk. A break below $4,020 would suggest weakness returning to the market. In technical analysis, the more times a price level is tested, the more likely it eventually breaks. Gold has already tested this lower zone multiple times recently. If it fails again, a deeper move lower becomes the more probable outcome, potentially setting up what technical analysts describe as a triple bottom pattern, or worse, a move beyond it. What makes this moment particularly interesting is not just these two levels in isolation, but how they interact with each other. Silver and gold rarely move in complete isolation from one another. They are connected through what is known as the gold to silver ratio, a number that reflects how many ounces of silver it takes to equal the value of 1 ounce of gold. This ratio has quietly been shifting in recent sessions, moving from a bullish structure toward a bearish one. For those unfamiliar with this concept, the importance may not be obvious at first. But this ratio has historically been one of the most reliable signals for understanding which metal is truly leading the market. When the ratio begins falling, it typically means silver is starting to outperform gold. This usually happens during periods when confidence in the broader precious metals rally begins to strengthen, as capital rotates from the safer, larger market of gold into the smaller, more volatile silver market. This is why serious investors do not simply watch price. They watch structure, they watch levels, and most importantly, they watch the relationship between markets, because it often reveals shifts long before the average investor notices anything at all. Right now, silver and gold both stand at levels that will likely define their next major direction. But underneath these two markets lies a signal that connects them both, one that has only shifted like this a handful of times in recent years. Understanding this signal may be the difference between reacting to the market late and recognizing the shift before it fully unfolds. While most investors keep their attention fixed on the price of gold or the price of silver individually, there's a quieter number moving in the background that often tells a deeper story than either metal alone. This number is called the gold to silver ratio, and right now it is doing something that deserves close attention. The gold to silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. It sounds like a small technical detail, but historically, this ratio has acted as one of the clearest early signals of where capital is flowing within the precious metals market. When the ratio rises, it usually means gold is outperforming silver. When the ratio falls, it usually means the opposite. Silver is starting to outperform gold. Right now, that ratio is shifting. After a period where its structure looked bullish, meaning it was expected to keep rising, it has now changed direction and moved into a bearish structure. In plain terms, this means the balance of power between the two metals is quietly changing, and this is not a random or short-term wobble. Ratios like this typically shift only during meaningful turning points in the broader metals market. To understand why this matters, it helps to think about how capital behaves during different stages of a precious metals rally. Gold is often seen as the safer, more established asset. It attracts capital first during times of uncertainty because it is larger, more liquid, and considered more stable. Silver, on the other hand, has a much smaller market. This means it takes far less capital to move its price significantly. As a result, silver tends to be more volatile, both on the way down and on the way up. When confidence begins building in the broader precious metal space, capital does not stay in gold alone. It starts moving into silver as well, often at a faster pace, simply because less money is needed to push its price higher. This rotation from gold into silver is exactly what tends to cause the gold to silver ratio to fall. And this is precisely the pattern beginning to appear right now. Based on recent structure, analysts are watching for the ratio to potentially fall further, moving from its current level down toward a range between 59 and 64. If this happens, it would reinforce the idea that silver is entering a stronger phase relative to gold, something that historically has only occurred during specific windows in the broader market cycle. For someone unfamiliar with this concept, it might seem like a small technical detail buried deep inside a chart. But for those managing serious wealth, ratios like this often carry more weight than the headline price of either metal. They represent the underlying flow of capital, the quiet decisions being made by larger market participants long before that sentiment shows up in mainstream financial news. This is often referred to as the insider layer of market analysis, not because it is secret or hidden intentionally, but because very few casual investors take the time to study it. Most people simply watch whether gold went up or down that day. Few take the extra step of asking why silver is moving faster or why the relationship between the two metals is shifting in the background. This is exactly the layer of analysis that separates reactive investors from strategic ones. Reactive investors respond to price movements after they happen. Strategic investors watch the structural relationships that tend to move first, giving them a clearer picture of what may be coming before it becomes obvious to everyone else. Right now, the shift in the gold to silver ratio suggests that the broader market may be entering a phase where silver could see stronger relative performance compared to gold. This does not mean gold becomes unimportant. It simply means the internal balance of the precious metals market is quietly repositioning itself. For business-minded individuals and long-term investors, this is the kind of signal that deserves attention, not because it guarantees a specific outcome, but because history shows that shifts like this rarely happen without reason. Something is changing beneath the surface of these markets. And in the next part, this changing pattern connects to something even larger, a signal coming from outside the precious metals market entirely. Precious metals never move in a vacuum. To understand where gold and silver may be heading next, it helps to step outside these two markets entirely and look at a third asset that often reveals the broader economic mood: oil. Oil is currently experiencing a sharp pullback, dropping close to 7% after gapping down heading into the new week. On the surface, this may look unrelated to precious metals, but oil often acts as a pressure gauge for the wider economy. When oil falls sharply, it can reflect concerns about slowing economic activity, weaker demand, or shifting expectations around growth. These are exactly the kinds of conditions that historically support demand for gold and silver as protective assets. Based on long-term support analysis, oil is now approaching a significant zone, roughly between $76 and $82, where historical buying pressure has previously emerged. Using a common technical tool that maps out expected support and resistance zones, one level in particular stands out with unusual precision, close to $79. This is the kind of level that experienced analysts watch closely, not because it guarantees a bounce, but because it aligns with multiple historical reference points at once. Why does this matter for someone focused on gold and silver? Because oil, currency strength, and precious metals are all connected through the same underlying economic story. When oil weakens sharply while gold and silver show early signs of strength, it often reflects a broader shift in how capital is positioning itself. Investors begin moving away from assets tied directly to economic growth and toward assets that protect wealth during uncertainty. This is also a good moment to address something important, the psychological side of investing. Markets rarely move in a straight line, even when the long-term direction is clear. Analysts often describe certain price patterns as designed to shake out both sides of the market. Prices may rise just enough to convince latecomers to buy at the top. Then they fall just enough to convince nervous investors to sell at the bottom. This back and forth motion is not random chaos. It is a natural part of how markets transfer assets from impatient participants to patient ones. Understanding this pattern is critical for anyone serious about protecting long-term wealth. The temptation during these shakeout periods is to react emotionally, buying out of excitement near short-term highs or selling out of fear near short-term lows. But those who study market structure closely tend to recognize these moves for what they are: temporary noise within a much larger trend, rather than a reason to abandon a long-term strategy. This brings the analysis to the bigger picture. Many analysts following gold and silver closely believe both metals remain in the early stages of a much longer move, one that could unfold over the next 5 to 6 years, extending toward 2030 and 2032. Within that time frame, some project the potential for both metals to reach significantly higher valuations, with figures in the multiple triple-digit range mentioned for silver specifically. These are long-term projections, not short-term guarantees, but they help frame why short-term volatility, like the moves being seen this week, may ultimately be far less significant than they first appear. For business owners, entrepreneurs, and those building long-term financial strategies, this bigger picture matters more than daily price swings. Short-term charts show emotion. Long-term structure shows direction. And right now, multiple signals, silver's early bullish divergence, gold's cautious positioning, the shifting gold to silver ratio, and oil's pullback into a historical support zone are all pointing toward a market that may be preparing for its next major decision point. None of these signals guarantee a specific outcome. Markets are shaped by countless factors, and uncertainty is always part of the process. But when multiple independent signals begin aligning at the same time, it becomes a moment worth paying close attention to rather than ignoring. The technical structure is now in place. The relationship between gold and silver is shifting. Oil is signaling broader economic caution. And history suggests that moments like this, when several signals align simultaneously, tend to precede periods of significant movement in one direction or the other. What happens next will likely depend on how these key levels react in the coming days. And that final decision point, the moment where all of this either confirms a genuine recovery or unravels into deeper uncertainty, is exactly where this story turns next.